Index funds. These are the most straightforward investments you can make, and for most people, they're also the best. An index fund doesn't try to beat the market. It simply copies the market by buying all the stocks in a specific index, like the S&P 500. When you buy an S&P 500 index fund, you're essentially buying tiny pieces of 500 of the largest companies in America. Apple, Microsoft, Amazon, Google. You own them all in proportion to their market size. If the overall market goes up 10%, your index fund goes up 10%. If it goes down 5%, so does your fund. The beauty of index funds is their simplicity and low cost. Most charge fees of 0.03% to 0.20% per year, which means on a $10,000 investment, you pay $3 to $20 annually in fees. Compare that to actively managed funds that often charge 1% or more. That's $100 per year on the same $10,000. Over time, these low fees make a huge difference. On a $100,000 investment over 30 years, the difference between 0.1% and 1% in fees is about $65,000. That's money that stays in your pocket instead of going to fund companies. Index funds also give you instant diversification. Instead of trying to pick individual winning stocks, you own hundreds or thousands of companies across different industries. If one company fails, it barely affects your overall return because you own so many others. The track record speaks for itself. Over the past 30 years, the S&P 500 has averaged about 10% annual returns. No individual stock picker or fund manager has consistently beaten this over long periods. Even Warren Buffett recommends index funds for most investors. The downside? Index funds are boring. You'll never beat the market, only match it. But for building long-term wealth, boring often wins. You don't need to time the market, pick stocks, or worry about fund manager changes. You just buy, hold, and let compound interest do the work. Mutual funds. Mutual funds are pools of money from many investors that professional managers use to buy stocks, bonds, or other investments. The manager decides what to buy and sell, trying to beat the market or achieve specific goals. Sounds good in theory, but the reality is often disappointing. Most mutual funds are actively managed, meaning the fund manager is constantly buying and selling investments trying to outsmart the market. This trading activity creates costs, research, analysis, transaction fees, that get passed on to investors through higher expense ratios. The average actively managed mutual fund charges about 1% in annual fees, and many charge even more. On a $50,000 investment, you're paying $500 per year for professional management. Over 20 years, those fees compound to about $15,000 in lost returns. Here's the problem. Most mutual fund managers don't beat the market after fees. Studies show that over 15-year periods, about 85 to 90% of actively managed funds underperform simple index funds. You're paying extra for worse performance. Mutual funds also have other hidden costs. Many charge load fees, upfront or back-end charges of 3 to 5% just to buy or sell the fund. Some have 12 B-1 fees for marketing and distribution. These costs eat into your returns before you even start investing. The tax efficiency is poor too. When fund managers sell stocks for gains, those gains get passed through to investors as taxable distributions, even if you didn't sell any shares yourself. You can end up paying taxes on gains you never received in cash. There are some good mutual funds, usually low-cost ones that track indexes or focus on specific strategies. But most actively managed funds are expensive ways to get market matching or below-market returns. You're better off with index funds in most cases. Hedge funds. Hedge funds are investment pools for wealthy individuals and institutions. They typically require minimum investments of $1 million or more, so most regular people can't access them anyway. But understanding hedge funds helps explain why complexity doesn't always mean better returns. Hedge funds use sophisticated strategies like short selling, leverage, derivatives, and alternative investments. They might bet against certain stocks, use borrowed money to amplify returns, or invest in private companies. The goal is to make money regardless of market conditions. The fee structure is brutal. Most hedge funds charge 2 and 20, a 2% annual management fee plus 20% of any profits. On a $1 million investment, you pay $20,000 per year just in management fees, plus $20,000 for every $100,000 in profits the fund makes. These high fees create a huge hurdle. The fund needs to earn about 2.5% just to break even on fees before you see any returns. If the market goes up 8% and the hedge fund matches it, you only get about 5.5% after fees, while index fund investors get nearly the full 8%. The performance record is mixed at best. While some hedge funds have generated spectacular returns, the average hedge fund has underperformed the stock market over the past 10 to 15 years. Many famous hedge funds have closed due to poor performance despite charging enormous fees. Hedge funds also lack liquidity. Many require you to commit your money for months or years, with limited windows for withdrawals. During market stress, some funds gate withdrawals entirely, trapping your money when you might need it most. The complexity creates additional risks. Hedge funds can blow up spectacularly when their sophisticated strategies go wrong. Long-term capital management, Archegos Capital. These funds used complex strategies that led to total losses for investors. For wealthy investors, hedge funds might make sense as a small portion of a diversified portfolio, but the high fees, complexity, and mixed performance record mean most people are better off with simpler investments. ETFs. Exchange-traded funds combine the best features of index funds and individual stocks. Like index funds, most ETFs track an index and offer broad diversification at low costs. Like stocks, they trade on exchanges throughout the day, giving you flexibility in when you buy and sell. Most ETFs are passively managed, tracking indexes like the S&P 500, total stock market, or international markets. The expense ratios are typically very low, often 0.03% to 0.20% annually. You get the same diversification and low costs as index funds, but with more trading flexibility. ETFs are more tax efficient than mutual funds. The structure allows them to minimize taxable distributions, meaning you keep more of your returns. When you do pay taxes, it's usually only when you sell your shares, giving you control over the timing. The variety of ETFs is enormous. You can buy ETFs that track U.S. stocks, international stocks, bonds, commodities, real estate, specific sectors, or even specific investment strategies. Want exposure to emerging markets? There's an ETF for that. Interested in clean energy stocks? There's an ETF for that too. Some ETFs are actively managed, with fund managers making decisions about what to buy and sell. These typically have higher fees than passive ETFs, but lower fees than traditional mutual funds. The performance varies, but you get professional management at a reasonable cost. The downside of ETFs is the temptation to trade too much. Because they trade like stocks, some investors buy and sell frequently, trying to time the market. This usually leads to worse returns than simply buying and holding. The flexibility can work against you if you lack discipline. ETFs also have bid-ask spreads like stocks, meaning there's a small cost every time you trade. For frequent small investments, this can add up. Many brokers now offer commission-free ETF trading, but the spreads still exist. For most investors, low-cost broad market ETFs are excellent choices. They offer diversification, low fees, tax efficiency, and flexibility. Just resist the urge to trade them frequently. Buy quality ETFs and hold them for the long term. Did you enjoy this breakdown? Then, please subscribe and hit the bell.